The dilution risks is there for equity holders. There is no doubt about that. We hear about airliners, we hear about the cruise companies, hotels. But if you look at an aggregate level for non-financial companies, actually a repeat of 2008, the risk would be very low for dilution. The big question is for banks, but the big difference is that today the banks are much better capitalized than they were in 2008 and 2009. Back then, just the US banks had to raise $650 billion of capital after the crisis in order to rebuild their balance sheet. This time they could weather the stress test that the central banks have been running over the last few years to define capital requirements, and they can have all of that happening in 1 year. So if you see that stress test happening, banks would be adequately capitalized, especially in the Americas, a bit more risk in Europe and in Japan. But the decision to suspend dividends or to force banks to suspend dividends is a wise one. And then what we'll see is probably that banks will take some time to build the provisions. So in this context, if we see a V-shaped recovery, the risk is low. But if we were sort of to see a significant deterioration, then there would be risk for European financials, Japanese financials, and the Japanese market altogether, because the Japanese market is very operationally levered, so will suffer significantly in a downturn.
Francesco, good morning to you, my friend. Fascinating piece of research that you've put out talking about bricks and sponges. Why don't you explain what you mean by bricks and sponges, which talks about which companies are the better at absorbing the current situation?
Well, when there is an analogy, because it's always difficult to see a crisis and to say why equity is responding so well. And, the analogy is one of a sponge, because to a large extent, we have to think that companies invest significantly in CapEx. They go to net working capital. And if this net working capital is positive, then they can liquidate their inventories. They can cut the CapEx. They will cut operating costs. And by, through these processes, the company will be able to survive the crisis without having to raise any capital. Now, the brick is a company that when it's hit by crisis, then, damages happen. And there are companies like this, financials, banks are clearly bricks because they don't have capital that can liquidate. They are very operationally levered. And as soon as the crisis hits, it hits straight the equity. And that is, the big problem. But you got bricks among non-financial companies as well. An example being airliners. Airliners have got negative working capital. So that means that there is nothing to liquidate for airliners. They get hit immediately.